All right, good afternoon. You guys are stuck with me for the next 30 minutes because they gave me a little more time. So I'm sorry, but that's just the way it is. So on X.com, you have a lot of discussion that men apparently think about the Roman Empire every day. Who here thinks about the Roman Empire every day? Okay, so a few people. How often do you guys think about interest rates? Every day, so a few, about the same ratio. Okay, what is the short-term Fed interest rate? 3-month Treasury. Anyone know? Okay, so it's 5.5% right now, right? Hikes, higher for longer. But who here has taken a DeFi money market position? Anyone? Aave, Compound? Okay, all the degens, very good. So what happens in the DeFi money markets is actually that you have this interest rate dynamic, but it's a lot more volatile than you get in traditional finance. The high on the USDT IPOR rate this last week, just 1 week ago, any idea? It hit 37%. 37%, right? So here we are freaking out. You know, people who took mortgages, 2-3 years ago, and they took it fixed, they're dancing to the bank, but anyone who took a floating rate now is paying 6-7%. Maybe their mortgage repayments have increased by 2 or 3 times. So interest rates are a big deal, but very few people actually think about them on a daily basis. But at IPOR Labs, we think about them all the time. So again, my name is Darren Camas. I'm the CEO and co-founder of IPOR Labs. So IPOR is the interest rate derivative layer and the base for building structured products on Ethereum. Okay, so if we look at traditional credit markets, there are really kind of 2 major things. So if you take a fixed rate mortgage, there's a chance that you're dealing with these 2 things and you never knew it. One is a benchmark rate and the other is a interest rate derivative. So what's a benchmark rate? A benchmark rate is like the SOFR or the LIBOR. It's how much banks charge to lend to one another, or it's the overnight financing rate. And these rates are really important. The issue is actually they're self-reported, so there's also room for bankers to manipulate them. And that's exactly what happened in the LIBOR case. But if you're building in DeFi, you get this really nice dynamic where you can actually know what the rates are in the market without asking any corruptible person. You do a smart contract call. So we take this idea of a benchmark rate and we build it native for DeFi. So the whole goal is actually to build a yield curve and term structure for DeFi, because that's important if you want to take a debt instrument in DeFi that's longer than, let's say, 1 month. And so this is something that's lacking. And I'll get a little bit more into the utility of an on-chain benchmark rate later. But the other side of the protocol, on the IPOR index side, it is actually a public good that lives on-chain. It's printed every so often, and other parties can call to it. So if you want to set your interest rate module for a money market, for an NFT lending market, if you want to use it to structure debt, if you want to use it to structure deal terms, or if you want to use it to structure derivatives. And that's exactly what the other side of the IPOR protocol is. It's an interest rate derivative DEX. And so this allows anyone from retail users to professional risk managers to manage their interest rate risk for hedging, arbitrage, or a directional position. Okay, so if we look at the DeFi credit markets, or the DeFi markets in general, they're extremely immature. And how do we know? Because everyone's trading perps. Perps are a great way to speculate. But if you talk about exotic derivatives in the traditional finance sense, they're a really tiny proportion of the market. The vast majority of the market is actually interest rate derivatives. They're the second largest market, only to Forex, at $450 trillion notional, right? So this dwarfs all of the other markets. But, we're not paying attention to the interest rate spiking in DeFi to 37% because we're kind of degenerate. But for the market to be more mature, this dynamic needs to change. So we naturally think that actually this TVL that's locked in the interest rate derivatives, it will have to resemble something more like this in the long term. And this is exactly the opportunity that IPOR is capturing. As we move from speculation to actually market structure, we will see the maturities and we'll see this kind of base of the DeFi credit markets start to form. Okay, so this is the IPOR index. It's printed, let's say, block over block. It's actually a hat tip to the LIBOR in its name, but it's the interprotocol overblock rate. So it's printed, it's calculated block over block over block, or kind of the closest thing that we can get to real time in DeFi. And then it's published on chain. And this can be queried by external smart contracts, again, to structure debt, deals, and derivatives. And this should have some important value over the long run because you have multiple contracts that are actually pegging to it. So we may say that the value of the IPOR index would be tied to, let's say, the velocity, the volume, and the value of the instruments that are actually tied to the IPOR. So it's this public good that will set this term structure in DeFi, and anyone can use it. On the other side, we built the interest rate derivatives, and we took the best of traditional finance, and we married it with the best of DeFi. So a typical interest rate derivative is two banks exchanging fixed for floating exposure, right? You guys have probably never traded an interest rate derivative unless you're sitting in a bank because it's not accessible to you. And also in DeFi, you have to bootstrap two-sided markets, and it's very difficult. But we use the best of DeFi, which is the peer-to-pool model, to at least bootstrap the market. So what does that mean? On one side, you have a passive depositor. This passive depositor, their capital becomes like the balance sheet of a decentralized investment bank. I'll tell you a little bit more about what happens on that later. But they're effectively the derivative underwriters. The pricing of the instrument is done by the AMM. So the AMM is specifically built for the interest rate volatility that you find inside of DeFi. You can't do a simple X times Y equals K bonding curve because you're trading off different things. In interest rates, you're pricing for volatility, whereas in assets, you're pricing for volume and size and slippage. And then on the other side, you have the trader. So the trader comes in, they get a quote, they're trading against the pool, and it's effectively an RFQ system. Okay, so if we look at the structure of the DeFi credit markets, it'll start to look something like this. So if you look at it like a software stack, you have at the base the IPOR rate. So it's effectively a data layer. Then you have the derivatives, you have the primary markets, and then at the top you can build these kind of structured products. So you'll be able to see in the future these multi-calls that are taking a primary instrument, they're taking a derivative, and they're pegging that to the IPOR to create a nice structured product. So this is like one-click vaults where you can arbitrage. Let's say you can lock in your ETH staking rate, and you can arbitrage the differential between the DeFi native rates and T-bills that are being tokenized on-chain. So these are some nice, interesting structured products that we think that are going to come. And this is also why we built IPOR v2. And again, I'll get into that just a little bit later. Okay, so if you're a depositor in the IPOR protocol, again, you're forming kind of this balance sheet of the decentralized investment bank. So where does that money get yield? Right? This is always a big question, and after all of the collapses that we had last year, this is probably the question that we should ask ourselves. Okay, there's a return, where's it coming from, right? It's a basic question, but unfortunately in the last cycle we didn't ask it enough. But this is a visualization that is built right on the blockchain itself, right? This is actually plugging into the smart contracts to understand what's the state of the liquidity pool at any time. So what happens to your deposits is they go out first to yield from the money market. So you're getting this kind of benchmark rate. You're yielding from Aave and Compound. And if you're a DAI depositor, you're also getting the DAI savings rate. And then you have the cash reserves, which are going to pay out any immediate obligations, either on the liquidity provider side or to pay out the derivatives. And you also have some collateral that's being used to trade against the pool. So it's nice because you can see this entire mechanism live on chain, and you never have to ask, where is the money? Because it's just a nice visualization. So at IPOR, we believe a lot in the transparency and actually grasp the transparency that is available to us in DeFi and make it simply accessible to the users to understand where is their money in the machine. Okay, so what's the status of the IPOR protocol? So currently we're the number 12 derivative DEX by TVL at just a little over 13 million. And in that time over the last year, the derivative has underwritten over 4 billion notional value. And so this shows that it's an extremely cash-efficient mechanism, and that's maybe one of the biggest advantages of the interest rate derivatives. So if you look at something like Pendle, which is very different kind of yield stripping construction, yield stripping construction is very good to set fixed rates, but it's relatively capital inefficient because you have to lock the entire principal. In the IPOR mechanism, you're actually only locking up the collateral that you want to trade. Therefore, you can get high leverage, which in the interest rate derivatives market means capital efficiency. And also, if you're a depositor, you've been getting for the last year one of the best stablecoin yields, both stablecoin on stablecoin and liquidity mining yields across USDC, USDT, and DAI pools. So that's also important to understand because we're about to launch an ETH or a staked ETH pool. And that's coming for the V2. Okay, so what's the reason for swaps? Again, this just last week, the USDT rate, it wicked up to 37%. So that's happening because you have this kind of utilization curve on Aave and Compound. Actually, the last talk was talking about the construction of the markets. This is particularly the interest rate dynamic. So high utilization, high rates, right? Here is a nice screener by Delphi Digital. And they're using it to actually visualize what happens in very volatile times. So they use the IPOR, USDC, USDT, and DAI rates to actually visualize what happened in the DeFi credit markets on the weekend of the Silicon Valley Bank collapse, and also the kind of panic in the USDC DPEG. So you can see actually the different rate differentials. USDT went to the moon. Why? Because people wanted USDT or they were trying to get it. And actually you had some very interesting big brain plays where people were maxing out USDT, flipping it for USDC because they were betting on the repeg. So this is a really cool kind of primary market activity, but it also shows that there's different rate strategies that you can trade during these times. Okay, so on the liquid staking derivative, it presents to us a very nice, new, interesting market. So IPOR has been both presenting and trading the money market rates for USDC, USDT, and DAI. But with the V2, we announced the stake rate swap. So the stake rate swap is effectively allowing you to pay fixed, or pay floating on the Ethereum staking rate. And so the first swap will be actually underwriting the Lido staked ETH rate. So what are some of the strategies? Well, structurally, if you're looking at the market, you will think that more ETH will be staked over time. More ETH staked over time, it means that the yield lowers, right? So you'll be naturally on the receive fixed side. But tactically, you will be pay fixed if you think that, let's say, there's going to be a bull market and people are going to take on more risk. They're going to max out their credit lines to speculate. Or let's say there's a really popular NFT mint that runs every day now for the next 365 days, and there's a lot of actually on-chain activity, and there's a lot more rewards generated on this on the transactional layer, which also flushes up the ETH staking rate. So you have two different kind of tactical and structural ways that you can trade this. But if you look at some even like simpler constructs, you had a lot of people that doing leverage looping from ETH to staked ETH. So you take ETH, you borrow against it multiple times, and you put it in for staked ETH. So you can leverage loop ETH for staked ETH up to 4x. But if you don't actually lock in the rates, both on the ETH borrow and the staked ETH rate of return, your yield varies. So really, what is the purpose of the interest rate derivatives in this case? It's actually to lock in the rate differentials to have this arbitrage, to effectuate this arbitrage opportunities. Okay, so let's step back and let's think right now. So actually, we see a lot of stablecoins that are flowing out of DeFi. And I think that it's a very kind of short-sighted and kind of very late in the game movement. We're all preparing for higher, longer in the traditional finance, but just now in the last 6 months, we've seen a lot of stablecoins exit DeFi and go into treasuries. You also have the RWAs coming on chain that are either tokenizing treasuries or money market funds or effectively the SOFR. And I think this is maybe a late trend. So let's look to next year, right? Next year, Q1, we have or Q2, we have the Bitcoin halvening. Q3, the market is already starting to price in rate cuts. So what happens if we go on a risk-on rally? What happens if the crypto assets start to appreciate? We may see a return to risk-taking in DeFi. And actually, we're already seeing this in the IPOR rates, where actually during the depth of the bear markets, we were seeing actually sub 1% IPOR rates. Now the IPOR rates are floating in between 3 and 5%, so something more healthy and floating towards the TradFi rates. So when this reverts, you're going to see people that actually want to post their real-world assets as collateral to get back access to the superior DeFi yields. So because of this, we see IPOR as effectively a two-way yield bridge between the TradFi world and the DeFi world. And it doesn't matter whatever side is leading, the capital should flow to the rate of greatest return. So as I mentioned, we're launching IPOR V2. IPOR V2 was launched on Goerli this Wednesday. So if you want to go play around with it, you can go do so. There's a couple of major upgrades. So one is an upgrade to the entire architecture. Architecture, we're using the Diamond proxy, which is a proxy router that routes through the entire smart contract. What does that make for greater composability? You can easily zap into a position, and also you can make simple structured products much more simply, and also with just one approval. The other side is we have an upgraded risk engine. We introduced the risk oracle, which makes for more dynamic spreads based on the market temperament. We're extending the rate tenors from 4 weeks to up to 2 and 3 months. Those will be extended to 6 months and beyond with proper testing. And the main thing and the main innovation is the staked rate swap. So first, the staked ETH pools will go live, and then a couple of weeks later, the staked rate swap will go live. And so these are the major innovations for V2. And I wanted to stop here, see if you guys had any questions about benchmark rates, about interest rate derivatives, about the rates market. So IPOR index is structured, so it's actually it's a composite dynamically weighted benchmark rate. So if you go on IPOR.io, there's a research tab, and that goes to the quant library. There's a paper there called the IPOR index, but effectively it's a volume weighted average between the Aave and the compound rates. It's effectively a mid-market rate between the lending and the borrowing rate. Why? It's just because how the interest rate module is structured on Aave and compound. And actually, there was the first governance vote, I think 2 or 3 weeks ago, which historically it's been Aave and Compound V2 just because of liquidity. The governance vote passed, which very soon it will also include the Aave and the Compound V3 rates. And maybe I'll extend on this just a little bit. So on the governance side, my long-term view of the protocol is that the index will be actually the killer feature, right? The index is the benchmark rate, and then when you get this benchmark rate on chain, you can actually do very nice, data flows of how many assets are actually pegged to the IPOR, right? You might see money market X that spins up a credit market, a lot of liquidity flows there, and it wants representation in the index. So this goes through governance. So I would argue that actually governance inside the IPOR protocol maybe has one of the best use cases for decentralized governance of all. Okay, so the IPOR token. IPOR has a token. You guys can check it out. You just look for IPOR. And okay, so the IPOR token right now, its main utility is, okay, so we use something called the power token, which was a tokenomics primitive designed in-house. So first, it's an architecture. It means that a token can be, you have the IPOR token, which is staked for Power IPOR. Power IPOR can be then delegated to multiple modules, whether it be liquidity mining or governance or any other module. So first of all, that's open source. So if anyone wants to fork that, it's fine. That's what it was built for. So again, we're very much about public goods, right? Public goods and open source software. So the liquidity mining that you have in IPOR right now, it was designed by my co-founder. He's one of the best tokenomics gigabrains in the industry. And so it's something like, think of like V-Curve or Badger DAO Boost, but think of like a more fair market mechanism. So if you go on the Twitter right now, or the x.com of IPOR, you can see there's a zap in. But basically what's happening is you have a log curve for the IPOR that you stake and delegate to a pool, and then the liquidity that you provide. So a log curve means that it's ratio-based. So it's a ratio between your effective boost and the liquidity. So because it's a log curve, whether you're big or small, you can always attain whatever certain level of ratio that you're looking for. And so what that means is that actually there's a most effective point on this curve where it makes sense either to either provide more IPOR or provide more liquidity. So that means that there's actually should be some dollar value in terms of boost where you meet this most effective point on the curve. So it is a liquidity mining mechanism. It's also used for governance. And we have a lot of other things that are in the IPOR DAO, a lot of IPOR improvement proposals that will, that will expand the utility of the IPOR token. Okay, so in the real world assets to IPOR kind of scenario, so IPOR first at its core, it's trading the rates inside of DeFi, either the staking rate or the money market rates, right? But there are very liquid indices that you could trade, these like the SOFR or the treasury rates inside of DeFi, or you could potentially actually trade the yield on these tokens, which is a proxy to the SOFR, for example, right? And so these might be some future products that are spun up or, are requested through governance. And we wouldn't actually do the real world asset tokenization at IPOR, but it's part that it would play specifically is, let's say we go back to this, so it would be the derivative and both the data aspect, right? So for example, you might have your tokenized T-bill that you want to post as collateral. Maybe it's accepted as collateral inside of Morpho, and you're going to leverage loop it, right? So you would probably want to be tactically pay fixed on the real world asset. You want to be pay fixed also on the basically the liquidity you're providing, but then you're kind of put that in a vault where you're capturing different DeFi yield strategies. So it's both the data and the derivative layer in that kind of strategy.
How can you make the comparison of providing liquidity with the NDLP that has the underlying version, wrapped, and the principal token versus the B2 and STF or any other liquid state derivative? How will you make the comparison, and what's the main advantage besides what you mentioned, the collateral and the leverage you can take?
Yeah, so you mentioned Pindle or like yield stripping protocols. You actually have to lock the entire principal, and you get the principal in the yield token, right? So you're effectively locking in a future yield, but it's the entirety of the locked collateral. In the IPOR case, you're actually think of it more as a generalized interest rate derivative market where you're actually trading collateral on leverage. So it's kind of a different infrastructure, but if you think like Pindle can be a very strong data point for the long dated rates, right? So you could effectively have Pindle be part of the the IPOR forward rates, 6 month, 1 year, 2 year, and then you could actually trade the difference between what's happening in the market and the actual yield that you're getting on Pindle. So they have actually a symbiotic relationship.
All right, I think that we are done for today's keynote. So thank you very much, Darren. Very happy of knowing you.
Thank you, guys.
Thank you all for listening to the speech.